What's really going on in the crypto markets behind the scenes will be revealed today. You need to understand this because the moves you're seeing now are not normal. What we're seeing is a planned crash. It's fake, it's been planned, and its only purpose is to get you out of your position so that banks and whales can buy your assets at a discount. This is not advice about money. You're not crazy if you've ever thought the markets didn't make any sense. One minute you might look at the numbers and think things look good, but then all of a sudden a huge red candle wipes out hours or days of gains. That was planned. These aren't typical moves made by stores. These are planned events set in motion by the groups that control things the most. And the sooner you realize this, the sooner you won't freak out when they flip the switch. Before I explain how these planned crashes work and show you some real-life examples from this year, I want to let you know about something special I've made in the comment below that has been pinned: how to become an XRP millionaire. The whole package comes with a document, an infographic, a movie, and other materials that explain the strategies, insights, and breakdowns I use and study. Check out the saved comment below right away to get a quick look at the bigger picture and learn how to seize opportunities while everyone else is scared. Let's go back to the present moment. The first thing you need to know about how these crashes are planned is that people are always scared. This is not how banks dump into the market when they want to cause a sell-off. They put it next to scary news stories. It's going to happen over and over again. All of a sudden, scary stories, geopolitical worries, threats of global war, and economic scares start to fill the news. You might hear that the US just moved jets into place, that global tensions are rising, or that the Fed is warning of disaster. And at the same time, huge red candles crash into the charts. Here's what really takes place. Regular buyers look at the candles, read the news, and make their own mental connections. Oh no, this is because of the war, or the Fed is once again putting a lot of pressure on the markets. They sell quickly because they think it makes sense. The news is really just a cover story. The real reason the crash takes place is that big companies are selling at the same time. The best part is now here. Those agencies are already set up to make money in both directions. They not only dump huge amounts of crypto, which causes these fake crashes, but they also set up short positions ahead of time. In this way, the banks make twice as much money as the retail traders who lose their longs. First, from short bets, and then from buying back at the fear lows. Let's talk about numbers since this isn't just an idea. This is taking place now. The other day, over $100 million worth of ETH longs were sold in just 60 minutes. In the same time, long positions worth close to $500 million were wiped out across the whole crypto market. It's not a coincidence. That was planned. All of them were hit: Solana, Bitcoin, and XRP. And each of these flushes went in the same way. It was planned for institutions to withdraw money, and individual investors were scared off. ETFs are the tool that gives these companies the most power right now. And I can't say this enough. ETFs give companies like BlackRock, Fidelity, Grayscale, Vanguard, and State Street a huge amount of power over how crypto's supply and demand work. This is why it's shocking when you read the small print on how an ETF really works. As an example, let's look at the Bitcoin ETF. Outflows happen when buyers sell all of their ETF shares. These outflows mean that the owners of the ETF have to sell Bitcoin itself. This is where things get interesting. They don't need to sell that Bitcoin right away. In fact, BlackRock's rules say they can sell at any time during the next 21 days. In other words, if $5 billion worth of ETF redemptions came in last week, they could dump all $5 billion worth of Bitcoin on the market today. You can only imagine the shockwave that goes through the order books. Since they know exactly when to pull the trigger, they can set themselves up perfectly ahead of time with short deals. With just one private tip or signal sent from one desk to another, billions of dollars can be used against stores. This idea is not some far-fetched idea. Let's take a look at real recent events. BlackRock's IBIT ETF lost $1.2 billion in value. When that amount of money hit the market, it caused Bitcoin's price to drop by 10%. Fidelity lost $500 million worth of ETH. Because of this, Ethereum dropped 12%. In 2024, $18 billion worth of Bitcoin left Grayscale, which caused a 20% decline. Both Vanguard and State Street had smaller events, but they both caused big jumps in market instability that were felt all over. Don't forget that these are only the big coins, like BTC and ETF. The effect is stronger when you use the same ETF model on smaller cap cryptocurrencies like XRP or Solana. When liquidity is low, bigger moves can be made with less money. In Bitcoin, what looks like a simple wave turns into a storm in XRP. For both risks and chances, this is the part where retail traders are panicking, while institutions are taking the other side of all of those deals. And you can too if you know how these factory-made crashes work. This is what usually happens next. The market quickly recovers after these planned crashes. Just look at the charts to see how it works. Drop steeply, quickly bounce back, grind sideways, and then the rhythm starts all over again. Why? That's because organizations make money from both sides, not just the bad things. First, they get rid of the weak hands. Then, they let the market rise again, and so on. You have a chance right in the middle of this run. You don't sell quickly into an engineered dump. Instead, you wait for the setups, know how the market works, and ride the recoveries. Bigger picture shows that XRP and the market as a whole are still going in a strong, long-term direction. The economy is showing rising GDP, rate cuts are still a possibility, and the use of AI is making the world more efficient. Long-term, these aren't bearish signs. They're just short-term manipulation cycles on the way up. Institutions depend on one thing above all else: people acting in ways that can be predicted. Retail buyers are easy to predict. People get greedy and buy a lot when prices go up. People get scared when prices drop and sell all at once. The cycle has happened so many times in commodities, stocks, and now crypto that it's almost built into the way people think about the market. The main reason these planned crashes work so well is that most of the people who take part never learn from them. They keep getting upset over the same things. This is how the cycle usually goes. The first step is to set up. In a quiet way, institutions set themselves up. This could mean taking on big short positions, planning outflows from ETFs, or just holding on to a lot of tokens they're ready to sell. At this point, nothing exciting takes place. The charts seem to be pretty quiet. A lot of the time, retail traders get comfortable and think that everything is safe. The second step is the spark. Now is when the news gets really hot. Suddenly, a bunch of stories will show up at once. For every pattern, there is a cause. Sometimes it's political, sometimes it's macroeconomic, and sometimes it's all about crypto. Just as banks start to sell into the market, fear-based stories start to appear in the media. The fear spreads like wildfire because people in retail get their news right away. Step 3 is the rise and fall. When this happens, prices drop sharply, stop losses are set off, leverage players are forced to sell, and the pressure to sell builds. It only takes a few $100 million in institutional selling to cause billions of dollars worth of sell pressure. That's why charts look like rocks during these events. Not only does the initial selling make the move bigger, but so do the forced liquidations and fear exits that follow. Step 4 is the yield. Once the planned crash has flushed out weak hands, institutions begin buying back in. This can happen in silence or with a quick candle that reverses direction and erases half of the dump in hours. Either way, retail is left reeling. People who sold quickly out of fear are now sitting back and watching prices rise without doing anything. People who held on during the drop are often afraid to buy more because they don't want another drop. While this is going on, organizations reload their bags at the lowest prices. It's happened a million times before, but it's even worse in crypto because the market is so unstable and shares are quickly sold off. Leveraged trading platforms make it even easier for institutions to cause cascades because the automatic selling takes care of the hard work once enough longs are sold. To show this, let's look at how the price of Ethereum has changed recently. At about $4,500, ETH was showing strength, people were very happy, and long bets had a lot of leverage. It looks like the right place for a harvest. Along with news stories about economic instability, institutions began to unload. ETH dropped below $3,500 very quickly. A lot of longs were killed. A huge amount of money was wiped out. The water fell and did the rest, and within days, the price of ETH fell well below what anyone thought was possible just a week before. Now check out what came next. It was a sharp bounce. ETH made its way back up, making huge gains for people who bought when it was cheap. That bounce back wasn't a miracle. It was the same cycle. Crash, liquidation, harvest, and comeback that were planned. There is clear risk here, but there is also clear chance. If you know the rhythm, you won't have to respond emotionally. You instead get ready. You don't chase green candles at the top of the cycle or sell in a panic when there is a planned drop. You don't let your feelings get in the way. Instead, you use logic. That's how you change from being the cash to the counterparty. Let's talk about why this is going to be even more important from now on. The way ETFs are set up isn't going away. In fact, it's getting bigger. ETFs for Bitcoin and Ethereum are just the beginning. There will soon be Solana and XRP ETFs. When they come out, even more items will use the same mechanics we're seeing now. And it has a bigger effect when the market cap is small. Take a look at this. Taking out $1 billion worth of Bitcoin could cause the price to change by 10%. But if $1 billion leave the XRP market, it could cause huge waves in the market. It's easier to change the supply when there is less cash. This is known by institutions. They're not just getting ready to make money from the majors. They're getting ready to take over all altcoins once ETFs are fully operational. Don't forget that they don't even have to be fair within the ETF system. They have a huge edge because they have 21 days to sell outflows. There is no requirement for them to be honest about when their sales happen. They can sell everything at once if they want to. They can spread out sales to make a decline last longer if they want to. There is no stopping them from combining sales with smart short positions. They always hurt stores when they do this. This is the reason why it's important to look ahead and plan. Short-term changes will always be planned for. Long-term course, on the other hand, is set by principles: adoption, fiscal policy, and new technologies. We still believe in the basics of crypto right now. GDP is growing in a good way. Rate cuts are coming soon. Using AI is making all kinds of businesses more efficient. The amount of money will grow. These are not long-term signs that the market will go down. In the short run, manipulation cycles make them less important. These processes will keep going because they work. Stores haven't learned their lesson yet. You see the same posts on social media every time there's a crash. It's over this time. Crypto is dead this time. After only a few months, prices are higher than they were before. People who sold in a panic are now behind, and the institutions that planned the crash are the ones with bigger bags. Let's also think about how this affects people around the world. It's not just organizations in the US that have ETFs. There are also international players. Foreign banks, sovereign wealth funds, and multilateral asset managers are all getting involved with crypto. They can make the cycles more organized if more of them take part. There is planning at the top levels of what looks like chaos on the charts. People who work in shopping often get the market wrong by thinking that it is free. They think that crypto can't be hacked because it is decentralized. However, price movement is not spread out. Exchanges are run from one place. Liquidity pools have a limit. Big companies run ETFs. It's possible for the assets to be decentralized, but not the trading system. That's where manipulation takes place. The strange thing is that as crypto grows in popularity, it is controlled more. Bitcoin was a niche product in the past, so price changes were wild but natural. With ETFs and a lot of institutional participation today, price action is still crazy but made up. That's the price of being widely used. This is one reason why planned crashes are still a thing. Why does XRP bounce back so hard? Just two main reasons. First, the people who live there are strong and dedicated. Short-term sellers may be spooked by retail chaos, but long-term investors keep buying on dips. Second, institutions want to be exposed to XRP because it helps with business uptake and cross-border settlement. In other words, every engineered dump isn't just a way for banks to make money quickly. It also gives them a chance to reload XRP bags for the long run. Think about what this will mean in the long run. What does it say about their view if institutions are working hard to get regular people out of XRP positions while they are also buying more? It means they think keeping XRP for a long time is worth it. They just don't want to pay the high prices set by stores. They need something cheap, and the only way to get it cheap is to make people afraid, dump it, and buy it while stores are in a panic. Crypto has always been about upsetting things and getting rid of things that don't work well. Bitcoin brought up digital scarcity and decentralization, which started the discussion. Ethereum made it better by letting you program it and making decentralized apps. But XRP has always gone its own way, making it faster, more efficient at settlement, and able to connect the flows of big money. If XRP is approved as an ETF, it will connect to the same trust and accessibility routes that helped Bitcoin and Ethereum become well known. This isn't just another thing of value, it's one that was made to fit the halls of global banking. The ripple effect that happens when regulations are finally clear is one of the most interesting things about this situation. XRP and Ripple have been fighting lawsuits, government actions, and a cloud of uncertainty for years, which made many organizations hesitant. Now that the SEC has approved an ETF, some of that fog is starting to clear. It's possible that banks, payment companies, and money transfer services that have been quietly watching may now feel ready to step in. From what if regulators crack down to what happens if we don't adopt this fast enough, the story changes. That change in tone is very important. Think about how gold ETFs changed that market. Before SPDR Gold Shares GLD came out in 2004, most people who wanted to trade gold did so through futures contracts or real holdings, which were both difficult for most investors. When an ETF made it easy to buy gold like buying stocks, it became very popular, there was more trading, and prices were easier to find. GLD is now one of the world's biggest ETFs. It's possible that XRP is about to have its own GLD moment. Liquidity doesn't just make prices go up, it also keeps them stable, lets more people participate, and speeds up the trust feedback loop. International placement is another layer to think about. Outside of the US, XRP has been used for a long time. Even though there have been problems with US regulators, Ripple's relationships with banks and payment corridors have grown in Asia, Europe, and Latin America. Now that the SEC has approved XRP, it has more credibility, which could help it spread even more internationally. Japanese financial giants, for instance, have been publicly excited about Ripple's technology for years. European authorities are making it easier for crypto to be used, especially through the Markets and Crypto Assets Regulation, MiCA. When these places see the U.S. introducing an ETF, it encourages them to follow suit and makes the case for greater integration stronger. It will be easy to buy and sell ETFs and the new derivatives and financial goods that they make possible. This is because options markets, leveraged funds, and complex products all work best when there is an underlying ETF. These goods are very important for institutions' risk management, yield strategies, and hedging needs. For retail, they give you more ways to engage than just holding. With this web of financial planning, XRP could become more widely used in the future than ever before. But there's also a paradox that needs to be talked about. Some early purists say that crypto assets lose their edge and radical spirit when they become valid through ETFs and institutional adoption. Some people have said that XRP is too controlled or too corporate, so it has always been a touchy token in this area. In this new phase, though, those traits may be what make you strong. Institutions don't always want independence that leads to chaos. They want speed, dependability, and to know that the tracks will work perfectly. XRP can do that, so Bitcoin will continue to be digital gold and Ethereum will continue to power decentralized finance. XRP, on the other hand, can become the institutional bridge asset, and its role will only get stronger once ETFs are approved. In the short run, there will always be volatility. Traders may see big changes as they try to figure out how to price in new knowledge. The approval is a spark, but the market will need time to process new money coming in, arbitrage possibilities, and how institutions are positioned. Some funds might put money in right away, while others might wait until the traffic is stable. When people accept at different rates, it can lead to a rolling wave effect, in which prices don't just go up all at once, but keep going up as more money flows in. We can also expect stories to change quickly. It's already being said that XRP's approval moment is similar to Ethereum's ETF acceptance. When Bitcoin and Ethereum first came out, neither had a clear link to the world of payments and cross-border settlements. XRP, on the other hand, does. When a foreign bank adds on-demand liquidity from RippleNet, ODL, it makes XRP more useful in the real world. ETFs give them more credibility in the financial world, and their use case keeps getting stronger as more people use them. This two-part driver isn't common in crypto, and it's one reason why XRP's path could be very different from that of its peers. Let's get even farther away now. Think about how the world's finances will be in 5 or 10 years. Central banks are looking into digital currencies, payment networks are going digital, and every day trillions of dollars are sent across borders. In this changing environment, assets that are both quick and in line with regulations will stand out. Giving XRP an ETF is not the end goal. It's the ticket to get in. It gives the asset a chance to work with the biggest amounts of capital and change the way value moves between countries. Of course, there are still problems. Clear rules today don't mean things will always be easy in the future. Changes in politics, new technologies, and changing foreign standards can all stop progress. But the ETF milestone gives XRP a safety net of credibility that will be hard to take away. When an object is linked to the financial system through ETFs and institutional holdings, it gets harder and harder to get rid of it. Investors should pay close attention to how sticky that is. Investors may start to rethink their investments in light of this new situation from a strategic point of view. For many years, crypto exposure was seen as risky and was usually limited to a small part of total assets. On the other hand, as more ETFs are released, XRP may join commodities and real estate as alternative investments. Pension funds, endowments, and national wealth funds, which have a lot of power, may decide to spend their money in ways that change the baseline of demand for good. Even a small amount of allocation from these big players could make the daily trade volume of XRP look like nothing. It's also important to look at the change in how small buyers think about things. A lot of people see ETFs as a sign of quality. People who would never open a crypto wallet or figure out how to use an exchange may now be able to buy XRP exposure with just one click in their trading account. Here's where legitimacy and accessibility come together to make huge waves of involvement. If you put XRP next to Apple and Microsoft in a trade interface, the things that used to scare people away from it disappear. The past has shown us that there aren't always changes in the money world. They happen in stages. Bitcoin came up with the idea. Ethereum opened up more options. With its ETF, XRP is now building a link to traditional banking that can bring the two together. Every step builds on the one before it, speeding up the process until what was once unusual is now normal. It's possible that we're seeing that change happen right now. It's simple to get lost in graphs, price calculations, and guesses about what will happen tomorrow. but there's more to the story than that. The acceptance of an XRP ETF is a big step forward for not only one token, but also for the history of finance as a whole. It means digital goods are no longer just around the corner. They are going right into the middle of the world system. The road ahead will be both important and unpredictable for people who own XRP and people who are just interested. At this point of change, where new wealth paths are being made, people who really want to know how to place themselves will want to look into the XRP Millionaire Blueprint, which is a tool made to help people through just this kind of moment.